Welcome back. We have with us Varun Goel, Senior Fund Manager, Equities at Mirae Asset Investment Managers, to take us through the market view. This afternoon, Varun, great to have you on. So it's a broad-based recovery that we're seeing, and the bulls will really, heave a sigh of relief. But tell us, what changes, if any, have you been making to the portfolio? What have you been sort of offloading in the market, and what have you been buying into this fall? Because there's been a fair amount of churn. So just tell us the top-down view and the whole portfolio stance right now to begin with.
Good afternoon, Subhi. Thank you so much for having me on the show. I think in the last 5-6 months, we have seen Nifty correcting around 10-12%. And I think the small and the mid cap space has seen a much bigger correction. If I'm not wrong, as of yesterday, the small cap index has corrected around 19%. So there's a lot of interesting and exciting opportunities emerging there. From a broader market perspective, of course, the market has to navigate 4 large events. One, of course, is the earnings season, which continues to be, and I think it's a little somber. We also have, of course, the new administration in the US, and we expect some more announcements to come along the way. And then, of course, the next week we have the budget and then the RBI policy. So, I think these are 4 large events, and we hope that some more measures will be taken both by the government and the RBI to revive the growth. We have been seeing some kind of a cyclical slowdown. So our sense is, while FY25 will be low single-digit kind of earnings growth, FY26 is where we should go back to that 12, 13, 14% kind of earnings growth, and we should see a healthy compounding for the markets also to start coming back. I think last year in February, markets were at around these levels, so we are almost spent a year with almost low single-digit or zero kind of returns. As the cyclical bounce in the economy plays out, as we see more investment in infrastructure coming back, as we see revival of rural consumption post the harvest of the Rabi crop, which looks quite healthy, I think FY26 should be the year of revival in GDP growth and, of course, market earnings also. So remain constructive on the large cap space. I think small cap space definitely has become very, very interesting post the recent correction, and we continue to find several opportunities there.
All right.
Can you talk about these opportunities?
So I think, if you look at the various sectors which have seen fairly large corrections, so if you look at whether it's capital goods, I think while there was some cyclical slowdown on investment, especially from the government side, I think, if you look at the medium-term trajectory, it still looks pretty interesting. I think residential real estate, again, something which has corrected quite a bit. I think the cycle, we are still in midway. If you look at the affordability metrics, so I think there are several opportunities there. If you look at the capital marketplace, I think fairly large price damages. That's again something to look at. So I think across the board, I think some of the more cyclical parts of the economy have seen very large corrections, and we definitely see opportunities emerging there.
All right. Hi, Varun. Good afternoon. Good to see you. And Varun, after this 12-13% correction on the Nifty, what all is in the price? The earnings miss is in the price because that's got scaled back. What else is in the price? The slowdown in the economy is in the price? Or do you think there's further downside? On the headline index first, let's talk about. Do you think that bulk of that pullback is done?
Yeah, so Nigel, so if you look at, so let's say FY25, we're looking at 1,050 EPS. I think if we take 12, 13, 14% kind of earnings growth, FY26, we're looking at, let's say, 1,200 rupees on Nifty. On that basis, we're trading at around 18.5, 19 times 1 year forward earnings, which is fairly reasonable. I think the 10-year average is around 17 to 18 times. So one could argue that we are still 5-7% more expensive, but then that correction may or may not happen. We don't know. It could happen in terms of time. It could happen in terms of price. So I think from a broader market perspective, we are, let's say 5, 7, 10% kind of correction is possible if you look at the historical matrices. But like I said, the more important thing is how quickly we see the cyclical revival in the economy. I think this year's GDP growth expected to be between 6-6.5%. Next year, we're quite hopeful that the government's infrastructure spend will come through. Some kind of stimulus in terms of tax cuts, if it happens, will be great. And of course, there is the expectation of rural recovery. All these things together will take the economy towards a 6.5-7% kind of GDP growth, and which will take corporate earnings back to that low to mid double-digit kind of range. And that should be the driver of the markets going forward.
Everyone's watching for what the budgetary allocation to capex is going to be for FY26, considering the slowdown that we've seen by government spending so far in FY25. Do you think keeping, how would you approach all these infrastructure, highway, roads, defense stocks, keeping that in mind?
I think while till November the activity was a little muted, but I think post that things have started to catch up. Definitely for sectors like roads, we've seen activity start in a very meaningful manner. I think some defense orders also came through, so it looks like the engine is that whole ordering ecosystem is getting back into action. And our sense is that the government will continue to focus very aggressively on the infra side, be it roads, railways, ports, metros, and some of those areas, and defense included. And we should see, a second round of growth acceleration in some of these sectors. So one is hopeful that we will see some of these stories come back in a meaningful manner.
What about this big debate on AI and the kind of disruption we are seeing from the big Chinese player? All of a sudden, it caused a lot of our tech stocks to sell off, but you can see a lot of them actually seeing some kind of buying interest. After all, tech was the one that was outperforming, and suddenly this news came and, it was trying to derail that entire rally and the interest in these stocks. What's your view on tech as of now?
Yeah, I think, so I think technology, AI is for real. It's going to be a bigger and bigger part of all of our lives going forward. So we can't deny that. I think as far as corporate India is concerned, Indian tech companies, they're embracing AI in their own manner. I think eventually, it's never good to fight technology. You have to all embrace it, make it your friend. And I think most of companies will be doing that. So we remain quite constructive on the tech space. I think broadly, if you see the very sharp depreciation in rupee, it would definitely cushion the earnings for most exporters, including IT, pharma, and to some extent chemicals. So I would be fairly constructive. Yes, AI may have impact in terms of what you call how many incrementally how much people are needed, and there needs to be some recalibration on that side. But I think most Indian companies will adapt to that in a very fast manner, and they should continue to thrive going forward.
Is EMS, any of the EMS related plays attractive post the correction?
Well, I think the sector definitely has a lot of growth potential. I think there are several sectors where government is introducing PLI opportunities, and therefore, be it auto, be it railways, be it semiconductors, a lot of these EMS companies will benefit. So, as and when we believe the valuations are comfortable, we would definitely look at that. But definitely, the sector has a long runway for growth.
Okay, all right. So those are some of the key spaces that you're looking at. Finally, Varun, to sort of distill it all down, run up to the budget. Any major expectations that you have? And again, in terms of positioning, are you expecting a big push again on capex? And therefore, what placement and sort of how much of exposure would you give that give that to the portfolio where it comes to the capex related plays and ideas?
Yeah, I think two large expectations, at least that we would have, is one, of course, on the capex, the thrust on capex to continue, and second, there's some kind of stimulus from a tax cut perspective for the middle class and the lower middle class. I think both these themes, we would hope would play out. Therefore, we expect some push on consumption side, especially the rural facing consumption, and of course the capex theme as we spoke about. So I think both these areas we would be constructive on going forward.
Thank you very much for that. Numbers coming in from Westlife.